If you're close to hitting $100,000 or if you've passed it, congratulations, because it's one of the biggest milestones in the personal finance and wealth building space. And while it will give you a lot of confidence and reaffirm that you are on track, this is where also people start making mistakes. Many people hit their first 100K and all of a sudden they change their strategy, whether they realize it or not. Today, I'm breaking down the 7 biggest mistakes people make after hitting 100K, and 2 of these you will not have heard anywhere else. Starting with number 1, complacency. So you probably knew that this one was coming, but let's say you hit $100,000, you might start to let off the gas a little bit. Let me show you how much complacency actually costs you. We're going to use a really extreme example here. Let's say you get to $100,000 and you have that entire 100K in investable assets. If at that point you decide, all right, I'm just going to stop contributing here and just let my portfolio grow as is. So $100,000 at an 8% average annual return for 30 years will grow to about $1 million. Honestly, that's pretty dang good. And it's not nothing. You would still retire a millionaire for just getting to that initial $100,000. And I understand that's why it's really tempting, but let's just indulge for a moment and pretend that if you're able to continue saving and investing the same way that got you to your first 100K in the first place, what would that result look like? In our hypothetical scenario here, let's say you are saving and investing $1,000 a month. If you do that for the next 30 years after you hit 100K, that amounts to over a $2.47 million ending balance. So if you're able to keep your habits exactly the same, the gap between what you have if you just stop completely versus if you just keep going is over $1.4 million. Now, in terms of the worst times to be complacent, it definitely is going to be the decade right after you hit $100,000. And the reason is that your contributions are so much more valuable than they will ever be because they have the most time left to compound. Every single dollar you invest in year 1 of a 30-year time horizon becomes around $10 at the end of 30 years, assuming 8% returns. Whereas if you invested a dollar in year 20 of a 30-year time horizon, that dollar invested at year 20 only becomes about $2.15 at the end of the time horizon. So there's actually a hidden piece of good news here, which is that if your first 100K takes you 7 or 8 years to save and invest up to, the next 100K should only take you about 4 to 5 years with the same contribution rate and investment returns. That's mostly because compounding here is helping you along, but if you can do this for the third 100K, the fourth 100K, and so on, your net worth simply accelerates more and more. Therefore, instead of having 100K feel like a finish line because of maybe how long it takes, I think this is the exact moment in which you need to lock in and realize that this is just the beginning. By just continuing your contributions, you can grow your net worth so much more. Mistake number 2 I see people making is kind of the opposite of being complacent, and I call it graduating. Now, in the traditional sense, graduating is a really great thing. You're moving on from one thing to another, you're in this transitionary phase, and you're on to bigger and better things. But what I see often happening is people hit 100K and they decide, okay, now it's time to graduate. They graduate into something a little bit different when it comes to their investments. Instead of investing in tried and true ETFs and index funds, they think that their proven success has given them the permission to start dabbling in concentrated individual stock positions, cryptocurrency, leverage, and options. They log onto social media and they see people making 10% a month, and they introspectively think, well, 10% a year sounds really boring when compared to 10% a month or 20% a month. And I really want to be honest here, I've actually felt this exact pull myself, which is that I've taken stabs at holding concentrated positions of individual stocks. I've traded options before, and when your account hits that 6-figure mark, there is something that changes in your brain chemistry. You say something like, okay, I'm pretty good at this stuff. Maybe I should just try to push my luck. But I'm telling you from experience, if you hear that voice inside of you, please just tell it to shut up. The flaw in this logic is really subtle, but a lot of people are going to miss it, which is that your first 100K is mostly proof that you're really good at saving money. It's not really proof that you're good at investing the money, and that's a big difference here. If you save $1,000 a month for 7 years and you earn roughly average market returns, then your first 100K, 84% of it is coming from the deposits or the contributions you made yourself. The market's contribution, the actual investing part, is maybe 15 to 16% of that overall pie, which is just not that much. And the second delusion that kind of is stacked on top of all of this is that if you've built your first 100K in the past 5 years, we've been in a really good bull market in the past 5 to 6 years. That means everything that you've invested in over the past 5 or 6 years has gone up, and so every decision has been validated by the market. Therefore, you yourself could be confirming your own biases here, which is, I am a genius, And this is when you maybe start investing in more speculative investments, and that can be fine for a little bit, but there's always going to be a time when the music stops. If you are really interested in day trading or perhaps investing in more speculative assets or concentrated positions, I would just say cap it at 5 to 10% of your portfolio, and hopefully in a separate account as well, so you don't touch your main portfolio account. Also, if it does go to zero, that way you're not completely destroying your progress and you're still kind of scratching the itch with 5% of an allocation. The main takeaway here is to know that your discipline built your first 100K, and that is the thing that you really want to protect and make sure you continue to do in the future. Now, this actually brings me to the other side of this same coin, because while people are out here gambling for an extra 10%, most people are simultaneously earning almost nothing on the cash they already have in their accounts. The average savings account in America right now earns 0.38% APY, so people take massive risk chasing returns on one side, and on the other, they leave money on the table. And this is actually the perfect segue into today's sponsor, which is Chime. Most people open a savings account, deposit money in there, and don't think much about it, which is probably why a CNBC survey found that about 82% of Americans still don't have a high yield savings account. Here's what that costs you. $10,000 at the national average rate of 0.38% APY earns about $38 over a year. That same 10K at a 3.75% APY earns $382, and that's an extra $344 from money that you already had. You just moved where it sits. And 3.75% APY is what Chime's high yield savings account earns, 9 times the national average, with no monthly fees and no minimum balance requirements. You can send a set percentage of every paycheck straight into your savings, so it lands there before you ever even see it. That's how my accounts are set up, and it means that the saving happens whether I'm paying attention to it or not. Your money isn't locked up either, and with direct deposit, you can get your paycheck up to 2 days early. So if you want to move your cash somewhere where it earns more and get up to a $350 bonus, you want to head over to chime.com/Humphrey, pinned at the top of the description below, or you just can scan this code on the screen. Setup takes a few minutes, and going through my link will get you the exclusive up to $350 bonus, and it will help this channel out. Once more, that's chime.com/Humphrey, and thank you to Chime for sponsoring this portion of the video. Let's get into mistake number 3 today, which is that people optimize for the wrong thing. And this might apply to some of you diehard viewers out there, which is that when you hit your first 100K, you start to pour enormous amounts of energy into optimizing your portfolio. People start to consider whether a 0.03% expense ratio beats a 0.07% expense ratio. They start getting into tax loss harvesting, backdoor Roth IRA mechanics, and asset allocation across different accounts. I've made videos about all of these topics, but optimization is one of those things where you can kind of get in the weeds of, and it's not that it doesn't matter, but I would just look at how much time you're putting into it. Let's say you're able to increase your portfolio's annual return by 1%, which would be elite level performance. That's worth about $1,000 a year at the 100K asset level. Meanwhile, if you're able to just optimize for your income instead, for example, a job switch, a promotion, a salary negotiation, that could be worth 10K or even up to 20K a year for most people. 10 times more the impact at the 100K level than trying to spend all your time trying to optimize that portfolio. I think the best part about getting a raise at your work too is that the raise will stick around for a lot more. It's going to compound every single year that you're earning that income. And so think about where all that income can go. It can go towards a 401k match. It can compound your bonuses even more as well. A 10K raise at the age of 30 is easily worth multiple hundreds of thousands in career earnings over time. And if you invest it, it could be worth even more. So this is typically true at the 100K level, but there will be a point in which it does actually cross over and that logic kind of flips. If your portfolio size was say $50 million, then I would say, okay, well, if you got an extra 1% per year, that's the equivalent of 500K, and that's definitely worth your time. The level at which this does cross over, the general rule here is that your portfolio needs to reach about 10 times your realistic annual raise potential. For most people, that's usually between 500K to $1 million, but below that, I would say that your career is the thing that you should be optimizing for instead of just trying to optimize your gains in your portfolio by 1% or 0.5%. Let's get into mistake number 4 today, which is that you will become a lead for complex financial products. And technically the mistake is not becoming a lead. You really can't do anything about that. The mistake is that people undergo an identity shift because they're constantly getting hit up by the salespeople within the financial industry. At around 100K in assets, the economics of selling to you really start to become lucrative for the whole life insurance salespeople, the financial advisors charging you high fees, or even alternative investment platforms. And this makes a lot of sense. If you only have 10K or 20K in assets, an insurance salesman doesn't really see you as a big enough target or a big enough fish to fry in their sales funnel. Now, the pitch that you're going to get, whatever the product might be, it'll have the same underlying tone, which is that at your level of net worth or your current assets, you really need something more sophisticated. They might say something along the lines of like, okay, yeah, index funds are great and all, but you're so successful that you've outgrown them and you could really use tax-advantaged permanent life insurance. It might be you could use active management, or maybe we can get you private deals that only we can get you. Well, let me show you what these sophisticated costs actually cost you. Let's start with the mildest version on this list here, which is the 1% asset under management fee, which is a traditional financial advisor fee that you might see. A 1% fee sounds like a tiny amount, especially on $100,000 in assets. It's about $1,000 a year, which is not crazy by any means. It is slightly annoying, but it's not crazy. But fees do actually eat into your returns every single year. So let's go back to our example in the first place. $100,000 growing at 8% over the next 30 years equates to about $1 million. But if you reduce that return to 7%, it's about $761,000. That's $239,000 less over the course of 30 years, and that's almost a quarter of your wealth that's being transferred to somebody else whose main service in many cases is just putting you in an ETF that you could have bought yourself. Now, not all advisors are bad. Some advisors can actually save you money and make up for their fee on a yearly basis, but if they're just investing for you, then in that case, I don't think it's worth it. Another option is a flat fee advisor where they just charge you a singular flat fee for their financial services for the year, and that makes a lot more financial sense as your assets get bigger and bigger as well. Now, that was a mild example. Let's take another product which is usually sold to people and that's more egregious, and that's whole life insurance. This is actually most aggressively sold to newly minted six-figure households, and you will not only pay a very costly monthly premium of a few $100s per month, but the premiums for your whole life insurance will go towards funding three main things. Number one is your own death benefit coverage, so that's included in your premium. Number two is your salesperson's commissions. And number three is your cash value. And this is what's different about whole life insurance that salespeople are going to try to convince you of. They'll say that the cash value is a savings component that you can invest and grow with tax advantages. But the thing is that your monthly premiums that you pay for the first 5 to 10 years, they barely even go towards this cash value. They in fact go to paying none other than your salesperson in the form of commissions as well as administrative fees and funding your own death benefit for your insurance coverage. Oftentimes, if you're 3 to 5 years into a whole life policy, you can't even surrender it either without having to pay extra fees. So the fees are front loaded in this case, and there's a ton of opportunity cost here because for the vast majority of people, I think if they just bought cheap term life insurance and then they invested the difference of what the monthly premium would have been with whole life insurance, they can make a lot more money. The deeper point of this mistake here isn't just about buying a bad product, it's about the identity that you might take on. And people start to abandon this simple, boring approach that got them to 100K because they think they need to do something different. But really, if it ain't broke, don't fix it. If you are being propositioned for a product, I want you to ask yourself 2 questions. First, can you explain the product in 2 sentences or less? If not, I would not consider buying it. And number 2, if you're considering a service or an advisor or someone helping you, you want to ask them if they're a fiduciary at all times. Anything other than an immediate yes from them is a red flag. So stay away from high complexity products, and I think you're going to be a lot better off in this case. Mistake number 5 today is what's called the Munger Trap. So Charlie Munger was Warren Buffett's right-hand man who recently passed, and at the time of his death, he was worth approximately $2.6 billion. There's a famous quote Charlie Munger is known for coining, and this is the following quote: "The first $100,000 is a bitch, but you got to do it. I don't care what you have to do. Find a way to get your hands on $100,000. He often stressed that you needed to get to 100K by any legal means necessary because after 100K is when your net worth would explode. And this is probably the most quoted or repeated piece of wealth building advice on the internet that's on every finance channel, including yours truly. Here's the problem nobody talks about, which is that this quote directly causes mistake number 1 from earlier on in this video. The implication that everyone takes away from this quote is that the first $100,000 is the hardest, and then everything else after that is easier. But as we know from mistake number 1 and throughout this video, that's simply not true. You don't want to just stop at 100K, and honestly, the second 100K is still mostly going to be just you and your contributions. But there is a level in which compounding in your portfolio does actually take over, and there's a simple framework you can follow to figure out when that point is. The rule is the following. You want to calculate when 8% of your portfolio exceeds your annual contributions. So pretend you're contributing $20,000 a year and you're earning about 8% average returns. For the portfolio to make more than 20K, which is your contribution amount, that means your 8% return needs to be bigger than 20K, and that doesn't actually happen until your portfolio is around $250,000. You can change this framework by whatever percent you are returning in the market. So if it's 7%, use 7%. If it's 5%, use 5%, etc. The funny thing is, though, is that the relationship here is that the more you contribute based on your habits, the bigger your portfolio needs to be in order for compounding to take over and actually beat your own contributions. The sixth mistake I see people making when they cross the $100,000 mark is more psychological and emotional, and it has to do with how much money you can gain or lose in the market any single given day. After people see this, they make the mistake of perhaps emotionally selling some of their holdings when they really shouldn't be even touching them. When your portfolio crosses the $100,000 mark, a 2% drop in the market is worth $2,000, or a 3% drop is $3,000, etc. And this actually messes a lot of people up psychologically. Think about how much money you would be gaining or losing if your portfolio size was $10 million. If it's a 1% drop, that's $100,000 in a single day. And a lot of people can't fathom that much money, and earning that much money in a single year is already really hard. And so those numbers, those absolute raw numbers, can really mess with your head. In reality, nothing has actually changed mathematically. So for example, if you lost 3% of $100, you would lose $3. That's far less consequential, and your portfolio would take equally as long to recover from that drop as the bigger portfolio of $10 million. Our brains just don't process percentages. It always processes, well, how long do I have to work in order to earn back that money? If you're checking your portfolio 5, 10, or 20 times a day and that number is stressing you out, and all of a sudden you say, okay, maybe this is a good time to take some money off the table, that's actually the worst idea, because based on all the data that we have, we know that that's not a good idea. The data shows that the market's best and worst days are usually right next to each other. So usually a big up day is going to happen right after a downturn, typically days or weeks after a huge drop. If you miss a handful of good days, it can cost you years of returns. And so the fix here is to make sure you do something before any bad day ever happens. I would personally pre-commit to never checking your portfolio on red days. And if you're checking on a red day, do not calculate the dollar number. Just think to yourself, okay, it's down 2%, fine, it's 2%, but don't let your mind wander to the actual dollar number if you're having a hard time with it. The market's gonna continually test your patience past $100,000, so you need to make sure that you have good processes in place. You want to, optimize for time in the market rather than timing the market. And mistake number 7 today is becoming the family bank. I know that it's kind of funny that I said that, but based on my DMs that I get on Instagram and TikTok, this might actually be the most painful mistake out of all of them. When you're the first person in your family or your group of friends to hit 100K or 6 figures, you have just been, whether you like it or not, elected the bank of your friends or the family bank. You're gonna get hit up for loans, a few $100 for a car repair, a couple $1,000 for a business idea, or you might actually get asked to provide someone's deposit for their first and last month's rent. But the expected return on giving a loan to a friend or family member is very negative ROI. I personally would never lend money to friends and family. You might feel obligated to give it to them because of your relationship. However, what happens is that if one person doesn't pay the other person back, it can create a lot of awkwardness and drama and strains the relationship. If you really feel like helping your friends and family out, give them a small percentage of what they're asking for just as a gift. So if someone's asking you for $1,000, just be like, listen, here's $100, never ask me for money again, and then you just take the L. They'll probably still take the money, you're still helping them out, but now there's no awkwardness if they never pay you back, and you get them to stop hitting you up for money. This protects the majority of your money, it protects the relationship, and protects your standing as someone who helps out rather than someone who just is there to collect their debts. If the request is bigger than your gift budget, the answer, I think, is a clean no. You might want to say something along the lines of, listen, I have a personal rule about loans and I don't break it for anybody because I've seen what it costs those people. So if you can blame it on a rule, it makes it a lot easier than saying you don't want to give them or don't want to help them out. And while we're on the same topic, I would also say the same thing for co-signing. So a co-signed loan is where you loan your credit score to someone else. And that someone else is not someone that's good enough to get a loan on their own. So when you are co-signing, you're literally taking on the liability of that loan. So if that person that you're co-signing for, they stop paying their payments or they default, then it's on you. If you're okay with that responsibility, that's one thing. But again, this can strain relationships, especially because you have no control whether or not your friend or family member pays their debts or not. If you have a story about lending money to your family or friends, please let me know in the comments as well, because I would love to hear how your experience went. So those are the 7 mistakes I see people making once they reach 100K in net worth. If you are guilty of any of these, please let me know down below. And if you're personally wondering how to build your wealth even further, you want to check out this video on the best financial strategies by income for 50K, 100K, and 150K and upwards. Thanks again to Chime for sponsoring a portion of this video. If you want to check them out, they'll be linked down below, but no pressure. I'll see you guys in a future video on this channel. Thank you for being here. All right, peace.